Hello, in this video we're going to be taking a look at capital investment decisions, which is chapter 11 in your textbook. So our learning objectives are to describe the importance of capital investments and the capital budgeting process. We're going to take a look at the payback method to make capital investment decisions. We're going to look at the time value of money as it applies to capital budgeting decisions. Now there's a separate time value of money video. Really, you should watch that before you watch this. It would be better. So if you have not yet watched that, do watch the time value of money video. That gives you the background that you need in order to use these discounted cash flow methods to make capital investment decisions. We'll take a look at those. So capital assets are assets that you're probably familiar with, things like buildings and equipment, assets that are long-lived and generally depreciated with the exception of land. And capital budgeting is the process of deciding which capital assets will be purchased. So it's a long-term budgeting kind of process because remember that these assets last a long time. So there are four tools that we're going to mention. The first is payback. The second is accounting rate of return. These are what we call screening methods. So think of them as the difference between having your resume looked at and getting an interview. So looking at the resumes is the screening process, and we look to see which of these are going to move on to the next process, which would be more like these tools. And so we're going to have the screening tools at the beginning. All right, so let's take a look at the payback method. The payback method simply says how long is it going to take the company to get its money back again. So we're going to take a look at a very simple payback example. Let's say that every day you go to Starbucks and you buy a coffee for $5. Now, an espresso machine could make the same coffee that you buy every day. The espresso machine would cost $600. Now, we're going to take a look at how long will it take you, if you buy the espresso machine, to earn that back by not having to pay for your coffee every day. And what we're going to do is take the investment, the $600 investment, and divide it by the daily cash flows. Now, in capital budgeting decisions, you're going to be looking at yearly cash flows. So this is a personal example. It's a little different. We're looking at daily cash flows. But the concept is the same. You're taking the investment and dividing it by the cash flows, and we find out how long it's going to take us to pay back. So in this case, where investment is $600, it's saving us $5 a day, it will take us 120 days to pay back. Now, is that acceptable or not, is the question. You might want to think about the fact that the espresso machine is going to last a long time, right? Probably at least 5 years, and it's only going to take 120 days to pay back. You also want to look at the fact that you are going to have some supplies, right? Like probably milk products and coffee in order to make your coffee. So that's the idea of payback. Payback says how long will it take us to get the money back, and then you would have to be given what the guidelines are. In other words, do you want to get paid back, in half the amount of time that the asset lives, or in what amount of time? So every company is going to be different. Every decision will be a little bit different. Now, what happens if our cash flows are uneven? So let's look at this example. Let's say, then this is more like an example of a company. Let's say a machine cost the company $100,000. Cash flows are uneven. So in the earlier years, cash flows are greater than the later years. So what we have to do is keep adding up until we get to the $100,000, right? Because we want to say how long is it going to take us to pay back the cost of the $100,000. So in the first year, we get back $40,000. The second year, $30,000. So by the end of the second year, our accumulated cash flows are $70,000. Add another $20,000 in year 3. And we're up to $90,000. Now in year 4 is where it gets a little tricky because now we need another $10,000 to get up to the $100,000, right? But in year 4, we get $20,000 of inflows. So how long is it going to take us in the year? Well, we need 10,000 and there's 20,000 occurring during the year, so it's going to take us a half of a year to earn that other 10,000. So our payback here is 3.5 years. Now again, if is that acceptable or not, we don't know, because we don't know what the company's criteria are. Now let's take a look at accounting rate of return. You are going to use that in your little Excel project. And accounting rate of return uses accrual accounting instead of cash flow. So most of the methods that we look at here use cash flows. And by the way, if you're confused about cash flows, there is a separate video that just looks at identifying cash inflows and outflows that you might find helpful. So the accounting rate of return, or ARR, is equal to the average annual operating income divided by the average amount invested. And now let's take a look at how we calculate those. So the average annual operating income is equal to the total net cash flows for the whole life of the asset minus total depreciation for the life of the asset, depreciation expense. Subtract those, divide by the asset's operating life in years, and that's going to give you your average annual operating income, or your numerator. Then, to find your average amount invested, you take the amount invested, which is the cost of the asset, add back residual value, and divide that by 2. Our decision rule is you will decide that this is an acceptable proposal, or with maybe to invest in the asset, or maybe to look at this further, right, using some of the other tools, if the accounting rate of return is greater than or equal to the required rate of return. Now, what is the required rate of return? We don't know. It depends on the company. It would have to be given to you. All right, so each company is going to have a little bit different required rate of return, which is also called the hurdle rate. Now, time value of money, I said you have a separate video on that. Make sure you watch that. It's very important. There are a lot of really important concepts there, not only for this, but for your life. The idea is that money received today is worth more than the same amount received in the future. So if somebody said to you, okay, I'll give you $10,000 today, or I'll give you $10,000 in 5 years, which one do you want? Well, you want the $10,000 received today because you can invest that money and earn interest. And so that $10,000 today is going to be worth a lot more 5 years from now, right? And there are other factors involved, which we talk about in the video. We're also going to look in that video about the difference between compound interest and simple interest. And this is very important because in your other accounting classes, you might have only used simple interest. But here, the tools that we use involve compound interest, so you need to understand those concepts. Now we're going to look at 2 different tools using the time value of money, 2 different capital budgeting tools. One's called net present value, which can be used in so many different circumstances, and internal rate of return. Let's take a look first at net present value. Net present value is saying, what is the value today of everything involved in this asset? So we take the present value of all of the inflows, all of the money coming in, subtract the present value of all of the outflows. Now remember that when you make the investment on the first day, that's already at present value because that's happening today, right? But the net present value is basically the inflows, the present value of the inflows minus the present value of the outflows. The way you find that present value is you use the required rate of return, which I mentioned is also called the hurdle rate, sometimes also called the discount rate. Goes by a lot of different names, but you'll know because it'll be given to you. And our decision rule is this: if the net present value is positive, then you're going to decide to make the investment, or say it's an acceptable investment, because positive net present value means that the return is greater than the required rate of return. Now, if the net present value is negative, you're going to say don't make the investment. It's not acceptable because the return is less than the required rate of return. Now let's take a look at our last tool. Our last tool is internal rate of return. The internal rate of return determines the actual rate of return of an investment. Now remember here, what we find out is if it's higher or lower than the required rate of return, but we don't really know what the exact return is on the investment. That's what internal rate of return tells us. And what it is the interest rate where net present value is equal to 0. So using the tables, your present value factor of an ordinary annuity is equal to the initial investment, the amount you paid for it, divided by the amount of each annual cash flow. Then you find the factor in the table. This is just like the case in our other video where we were looking for an interest rate, right? We got the factor, then we went back to the table and we look under the correct number of periods or years and find out what the interest rate is. If the internal rate of return is greater than the required rate of return, we accept it. If it's not, if the internal rate of return is less than the required rate of return, then you would reject that project. All right, so that's all I have for you here. See you in the next video.